All right, good morning and I guess good afternoon as we cross the 12 o'clock threshold here. Let's go ahead and get started. My name's Nate Zeller. I'm the Secured Financial Chief Investment Strategist. We'll get into my background here in a second. What we wanted to cover today is a recap of quarter two and really the first half of the year, as well as provide our outlook for the second half of the year and the third quarter. We're going to talk primarily about the markets today. Not a whole lot of investment strategy. We'll cover that here in a couple of weeks at a lunch and learn that we're planning. But let's go ahead and get into it. I will mention that this video is being recorded and will be uploaded to our YouTube channel. So you can watch the replay. Please tell your friends, families, coworkers. You can also subscribe to our YouTube channel and view all of our market huddles. If there's any that you've missed in the past or would like to catch some again. First off, before we get too far, we have to go through our disclaimer. Of course, any type of investing involves risk. There are no guarantees. Market conditions are subject to change without notice. And as we know, market conditions do happen to change rather quickly. The goal or the objective today is to educate and inform. So this is not meant to be used as any specific investment advice. Every individual's situation is different. And therefore, what we try to do is strive to tailor an investment plan based upon your unique needs. So if there's questions that you have specific to you, please give us a call and we'd be glad to discuss those and how we might implement some of the topics covered today in your portfolio. Start out real quick with a little bit of my background since I am new to secured retirement. I'm the chief investment strategist, began here last month. I'm responsible for the overall investment management and strategy for the firm, including the portfolio construction, analysis, and trading. I have over 2 decades of investment management experience. Previously, I did hold leadership positions with US Bank and Ameriprise, where I worked with affluent and high net worth clients throughout the country. Obviously, both of those companies are based here in Minnesota, so I'm local. I did receive my bachelor's degree in electrical engineering, a master's in business administration. As far as the engineering degree goes, I'm very analytical. I like to get into numbers. So hopefully I don't get too carried away with the numbers and graphs today. For all of you, I am a certified financial planner, and I also hold the Chartered Financial Analyst designation, or the CFA is what it's called. I think most of you are probably familiar with what a certified financial planner is, but maybe not the CFA. So I'll just briefly discuss what that is. It's a professional designation given by the CFA Institute, measures the competence and integrity of financial analysts. It's really a comprehensive study program in the field of investment management and research analysis. There's a series of 3 exams that you're required to pass in succession, and they cover areas such as accounting, economics, ethics, money management, and security analysis. There's also an experience and education requirement to receive the charter. A little more personal, as I do live here locally in Chanhassen with my wife and 2 daughters. You can see I don't have a lot of hair. I used to have a lot more before my daughters were around. And I blame that on them, but they say it's natural aging. All right, so quarter 2, what we're here to talk about is a recap of what happened in the second quarter of this year. We really saw continued market strength, driven by continued reopening after the COVID shock that we had last year. If you look back, there was a faster vaccine rollout than people maybe anticipated, which I think that if people would have looked at the end of the first quarter and said, okay, this is where we're going to be at the end of the second quarter in terms of everything being open, a vaccine being readily available, it would have been a surprise that we came as far as we did. In my view, especially here in Minnesota, I thought that we might all be wearing masks for a while yet. So that certainly did help the markets continue with their growth trajectory. The other part of it too is there was continued monetary and fiscal stimulus. We saw the stimulus payments go out in another round of those. Monetary is the Federal Reserve leaving rates low, which certainly helped out. Then the consumer confidence that was a result of the reopening. There was an improvement in employment as people got back to work. As at the end of the quarter, unemployment sat at 5.9%, which is much lower than the pandemic high of 14.8% seen in April of last year, but still a little bit higher than where we were pre-pandemic at about 3.5%. I think we're going to see a continuation of the employment improvement, especially here over the next few months as people, especially in the leisure and hospitality sector, get back to work. There's a number of people no longer in the workforce that were classified as being in the workforce a year ago, so that certainly is changing, and I think we'll see more of them return to the workforce here in coming months, and expect the unemployment rate to fall even further. There might be a few months where the unemployment rate stays steady or even bumps up, not because there's fewer jobs filled, but because more people are entering the workforce again. So it's more of a statistics number there. If there were any concerns during the quarter, there was some inflation. We're going to talk quite a bit about inflation here in a couple of minutes. It's one of the main themes today. But there was some concern over inflation during the quarter that then subsided, but I happen to think that we're going to see more inflation going forward. We'll talk about how that affects you. So our quarter two recap, we saw very strong returns across the board, especially in the S&P 500. If you look back to a year ago, now remember, we're just coming out of the pandemic after the shock. So those year-long numbers look outstanding, but they started at a very low level. But on a year-to-date basis, we're still looking very strong. Obviously, the S&P 500, which represents the largest companies, fared the best. The Russell 2000, which is small cap, smaller companies, did well, but not quite as well during the quarter. And there seems to be a bit of a disconnect, and I think there might be some opportunities within the small cap space. You can see over the last year they've done extremely well, so it only made sense they took a bit of a breather. Foreign markets, represented by the MSCI EFA, and the emerging markets had decent, solid quarters. But as I'm sure you're all aware, the vaccine rollout has been more difficult in some of those areas. We've seen some variations, of the virus, especially in places like India, that have had an impact there. So it's no surprise that those maybe lag the domestic markets a little bit and have a little bit of catch up to do. The Bloomberg Barclays Ag Bond Index did post a positive return for the quarter. Year to date, it's still lower, and compared to a year ago, it's lower. We're going to spend some time talking about interest rates here as well in a couple of minutes. You can see below what happened with the 10-year Treasury yield. A year ago, it was at about 0.7%, where now, as of the end of the quarter, is at 1.45%. Today, it's sitting at about 1.35. It was higher back in March, and there was inflation concerns that led up right at the end of the quarter, quarter one, that seemed to have subsided during the second quarter a bit, hence the drop in yield. The other piece that I'll mention here is the Bloomberg Commodity Index posted very strong returns. Those are driven primarily by energy prices. And if you look below there, you can see that the price of oil, and I'm sure you're all aware as you fill up your cars at the pump, that gas prices have come up rather considerably over the last few months during the quarter and year to date. So that drove the commodity index higher. Gold has not moved a whole lot. You can see, and this is interesting, that gold was lower, and I talked a second ago about inflation, being a concern in the first quarter of this year. You can see that gold was lower then than where it ended the second quarter. So, what gold prices have been doing is not necessarily indicative of the perceived inflation in the markets, and it had a much lower contribution to the returns of the commodity index as compared to their energy prices, especially oil. One thing I did want to point out is I'd mentioned I like charts and numbers, and this might be a little difficult to read. So that's why I blew up the end part of it here. So this is a 5-year chart of the MSCI All Country World Index. And right here, and I don't know if you probably can't see my pointer, you can see where it peaked prior to COVID, and then the very fast V-shaped recovery after COVID. And the market, and so this is the world market, but 60 to 70% of it's the US market. So if you look at the S&P 500, it's going to look very similar to this. It's well beyond where we were pre-pandemic, which would imply that we've seen great economic growth, or growth in corporate profits as well during that time, which isn't necessarily incorrect. A lot of people think about the shutdowns that happened during COVID and certain sectors, cruise ships, airlines, that suffered greatly. But on the other hand, there was a lot of innovation during the pandemic. You look at these technology and software companies that help people work from home, for example. A lot of the advances in medical, health technology that occurred. And so that's why there is such a strong rebound. Another thing that I'll mention too is there's a lot of talk in the markets about the markets being a little frothy or maybe overvalued. People look at the price to earnings multiples that are in the 40s for the S&P 500, when historically speaking, it's generally in the mid to upper teens. So it seems like it's gotten a little expensive, but I'll point out that that's a backward-looking number. We've seen some revisions to earnings expectations, and so the price to earnings, the forward price to earnings growth for the S&P 500 is in the low 20s, which really isn't that far out of line. And at the end here, I'll kind of describe what my thoughts are for the market going forward and where we anticipate it going from here. But overall, what I wanted to show is that we're well beyond pre-pandemic levels, and maybe it is getting a little high, but not necessarily too far out of line. The next topic, and a couple of charts here talking about inflation. So this is the year-over-year consumer price index, or the CPI change. This is the government Bureau of Labor Statistics measure of inflation on a year-over-year basis. There's the blue line there, which is all items, and the green line, which is all items excluding food and energy. The reason they do that is you can see there's a lot of variability within food and energy. However, I think that's kind of silly because everybody is a consumer of at least food, and I would think energy as well, so it should be included. But what I'm trying to point out here, though, is we've seen a rather large spike in both areas, even the core, the ex-food and energy, over the last few months. This is based on a year-over-year, so this is compared to a year ago. And if you remember, a year ago, with things, we're just coming out of the shutdown, and so we started from a very low level. So it's no surprise that we see such a large change on a year-to-year basis. However, I'm going to flip to the next slide here, and this is the absolute price level. And what I want to point out here is that we've seen a spike over the last few months, or spike, but you can see the trend line has really started to move much higher. And so I think that there is some concern over inflation. The Fed argues that it's transitory. We're just looking back compared to a year ago, and of course, as we've recovered, we expect prices to be higher. However, I think that there's a lot more going on in the economy right now. If you look, there's been all sorts of stimulus. The money supply is much higher than it was. There's much more demand, consumer demand for goods and services. The traditional definition of inflation is too many dollars chasing too few goods. And I think we're seeing that now because there were too few goods. There were disruptions to the supply chain. The input costs are higher. So there's a lot of factors leading to an increase, or what is projected to be an increase in inflation over coming months and throughout the rest of the year. The reason this is important is this has an impact on your investments and your purchasing power specifically. So if prices are rising, we'll just say at 3 or 4% a year, you need to make that much up just to maintain your purchasing power. And remember that your personal inflation rate may be very different than what the government's reporting. For example, if you like to play golf and the cost of a round of golf has gone up by 10%, your personal inflation rate may be much higher than what the government reports here. And so it's certainly something to be aware of. And the other part too is if the Fed funds rate showed a few slides back is near zero, and that's basically what savings accounts are paying, or if you have money hidden underneath your mattress, you're losing money. You're losing out on that purchasing power. to a pretty good extent. So it's important to find things that'll make up, especially on real terms, which means after inflation, is providing a positive return. The next topic here is interest rates. And this is switching gears a little bit, but certainly tied in to inflation. If we do see inflation, rear its ugly head, and not all inflation's bad. That's something that if the economy is growing, some inflation, some price appreciation is to be expected. If there is deflation or prices are going down, it's generally an indication of the economy contracting. So we want some inflation is good, just not too much. One of the Fed's mandates is price stability. And so they target about 2% a year for inflation. And that's what the average has been the past 20 years or so. So, moving forward to how this affects the treasury yields, like I mentioned earlier this year, there was a concern over inflation, and you can see down here on the lower right-hand side that treasury yields did, and I'm using the 10-year treasury here kind of as a proxy for the broader market to show an indication of interest rates. It did move up some, and then as inflation fears subsided to a certain extent during the quarter, it dropped a little bit. But historically speaking, at least over the past 20 years, and this chart goes back much further than that, there's been almost an inverse relationship, a negative correlation between values of treasuries and the stock market. And so if you remember back to 2008, when the stock market did very poorly, treasuries did quite well. Back then, the 10-year treasury yield was 4.5% or 5%. Today, it's at 1.5%. So the reason I bring this up is I'm not sure, well, I don't think that treasuries or fixed income, for that matter, provides a portfolio diversification that it sometimes has in the past. There just isn't much runway there. There isn't much further for it to fall. I mean, it can go to zero. We've seen negative interest rates in places like Japan and Germany. I think they have some other issues going on, especially with their demographics, and their economies aren't growing quite in the same way that the U.S. is. But regardless, there just isn't much further for these to fall. And I should have backed up here, just as a reminder that treasury, or the value of bonds, is inversely proportional to the yields. So think of it as a teeter-totter. So as yields go up, values go down. But as yields go down, values go up, like we saw in 2008. And there's this blip right here in the middle where treasury yields drop pretty significantly. We saw values of bonds go up, and it was a great diversifier for equity portfolios. But I just don't think that it's going to provide that type of diversification today, or risk management. So it probably makes sense to look at some other options within the portfolio. So looking ahead, we've talked about what we saw in quarter two. Looking ahead to quarter three and beyond, really the second half of the year, we're expecting more muted market returns. And when I say more muted, if you remember before, we're looking at double-digit returns. I still think that there's room for growth. Sure, the market maybe has gotten a little bit ahead of itself. The valuation's a little high, but the earnings projections, and we're seeing quarter two earnings start to come out this week. It'll be interesting. They've been revised upwards. So it seems that the earnings are going to grow to be more in line with what the market's showing us. And I don't expect there to be a market pullback. The market could be very flat going into the rest of the year, but I wouldn't be surprised too if we do see some growth. I just don't think it'll be quite as much as what we saw in the first half of the year. The monetary and fiscal stimulus will remain supportive of the growth. So the monetary is the Fed. They're anticipated to keep interest rates low. Fed Chairman Powell said that he doesn't expect to increase interest rates until 2023. Some of the Fed governors said that it could happen later part of 2022. Now, if we do see inflation a little higher than expected, that could happen soon. And later part of 2022, 2023, a long way off, and a lot of things can happen in that time. As far as risks, it really comes down to the valuations. Like I was talking about before, the market appears to be possibly a little overvalued. I think that inflation certainly will come into play. That this will be a key quarter for inflation. To see what it looks like, I think it'll give the Fed a better picture of what to expect. And as I mentioned before, that looking back the previous 20 years, inflation's run at 2% or better, so it's been pretty benign or low. I doubt that we'll see runaway inflation like we did during the 70s, but it wouldn't be much of a surprise at all if we were to see a little higher inflation rates, 3, 4, even 5% over the next few years, as this additional money supply works its way out of the system or through the system, and consumer confidence continues to increase. As far as, this is a little bit of investment strategy and portfolio positioning, which I, at the onset, said that we're going to discuss in more detail here in a couple of weeks. So I didn't want to get into too much today, but I thought I would throw this out here, as I think it's important to be selective with the sectors going forward. If there is inflation like we expect, things such as, your commodities, we expect oil prices to continue to increase. The raw materials such as copper, aluminum, steel, would most likely do well. Real estate's interesting. You can be very selective with real estate too. I would probably stay away from things such as office building REITs. As more people work from home, there just won't be the need for the office space. The housing, we've seen incredible gains in housing, and some people think that it might be a bubble there, but if you look at like apartment houses and rentals are certainly a good place to be. There's also some very unique REITs out there, places such as distribution and warehouse properties, other ones that do data centers. And so those things would do well. As far as sectors go to, with the market, like I'd mentioned before, I think we might see some outperformance with the small and mid cap, as well as even the foreign markets as they recover, especially the developed. I think the emerging markets, you look to India, who is struggling. They seem to have certainly turned the curve, rounded the bend there, and are improving with their COVID response. So it's something to be careful, but I think the EU is looking much better, and some other the developed economies. Also, the projected growth in those places is higher than the U.S. if we look out a couple of years too. So I wouldn't discount the foreign markets. Then the last thing that I will mention too is, consider alternatives to fixed income as far as portfolio diversifiers. There's a lot of things you can do. Income, like I'd mentioned, the 10-year Treasury is paying 1.35%. That's not very much for income. There's a lot of other options out there. This is really where it comes down to customization, as far as what you need. If you have a particular income need, we can look at things there. If you're looking at certain things to diversify your portfolio, there's other ways to hedge equity. And I'm not saying stay away from fixed income completely, and there's a lot of sectors there, but certainly be more selective in what you do. And that really rounds up what I was going to discuss today. I'll turn it here. We're here for you. Please don't hesitate to give us a call. You can reserve your retirement analysis today, your tax smart retirement analysis. I'm going to put this out there where you should be able to just click on that to schedule a time to talk with one of our advisors. Feel free to email us or call us. Stop by as well if you happen to be in the area. If you haven't seen the new office here, it's really nice. I encourage you to stop in. I'd love to meet as many of you as possible. I've had the opportunity to meet some people already in the time that I've been here, but I'd love to meet more. So please don't hesitate to give us a call if you have any questions or if there's anything we can do for you. It's also a good time too to review your portfolio, since this is right at the middle of the year. I'm going to open it up now for questions and see if anybody has any questions that I could answer, or maybe attempt to answer here today. So yeah, don't be shy. If you have a question, please do put it into the chat screen. Hopefully I have this open up the right way. All right, this is a great question. Thank you. What do I think of inflation protected securities? Thank you for asking this. This is something I missed it and meant to cover. I think that is a great way. We're talking about the inflation busters before. It's a great way to hedge against stock market risk and provide that inflation protection. Those are Treasury securities. So I was talking before about you know how the treasuries have provided diversification, especially in times when the market goes down. There tends to be a flight to quality, and a treasury is supposed to be as safe as it gets. And with inflation protected securities, that's a great way to do it. So yeah, thank you. And I do think it's something we started to implement in more of our portfolios over the last couple of weeks, and we will continue to do so going forward. What do I think of annuities? That's a very specific question. I think that annuities are very worthwhile to look into as a fixed income alternative right now. Some of those have some guarantees. We can't use the word guarantee very often, but with annuities we can. And if you look at it, they have a certain floor, and then they can participate in the stock market. So that's one way to, look at an alternative for fixed income, put some money into, say, an annuity, and then take the rest of the money, and that would be your safe money. Then take the rest of your money that you want for growth, and you can put it into the stock market. So that's a great question. One that we certainly love to sit down and have an individual conversation about, though it's not for everyone, perhaps. Other fixed income options. Yeah, they talk about REITs, short-term options in the fixed income space. There's some floating rate bonds. They're not paying a whole lot. Sometimes you have liquidity concerns too with a floating rate, depending what it is. And treasury, high yield bonds generally pay a decent amount of income. They are more closely tied to the stock market and the overall business cycle. So they don't provide the diversification that treasury does, but they certainly do provide the income. We can look at foreign bonds as well. So there's a lot, the one thing that we are doing when we are using fixed income is we're shortening the duration, as we expect interest rates to go up. If the duration's lower, those values will have less of an impact. And then if interest rates do rise, it'll provide us the opportunity to move out of the shorter duration and move to the longer duration and increase the income at some point. That's one thing that we do now, is we're very tactical with some of the moves that we make. Another question, any specific treasury securities? Like I'd mentioned, I don't know that treasuries outside of the inflation protected securities, which are a treasury security, I would recommend those. Otherwise, I don't think that I would be using a lot of treasury securities right now. I'd look more towards corporate bonds that provide a little better income. They are more susceptible to the volatility of the business cycle, closer, more correlation with the stock market. And so there's other fixed income that I would use outside of treasuries at this point. What are the best indicators to watch for clues on increasing of the supply of goods? Another great question. There's a lot of economic indicators out there. You have your producer price index, and that doesn't necessarily cover the supply of goods, but it does show the cost. And it comes down to supply and demand. So if we're seeing the cost increase greatly, that means that the supply maybe isn't keeping up with the demand. So that's probably where I would start. There's other other inflation measures too. So it's all about inputs of goods and services. So there's a lot of different numbers you can look at. The Bureau of Labor Statistics provides a lot of this information, and I'd be happy to circle back with you on the question and give you a little more specifics there. All right, any other questions here? I think we'll end it. Thank you very much for joining. Like I said, please give us a call, reach out to me directly if you do have questions, and we'd be glad to get back to you. But thanks for joining, and enjoy the rest of your day.